And the next item of income for our study is cash flow income. And by cash flow income, what it means is certain incomes which are cash flow in nature, not regular or recurring in nature, not necessarily recurring in nature, but then certain things which are cash flow in nature. Okay, so let's see what they are. And these are the items that fall under cash flow income. So I would suggest you to take down these items of income which would come under cash flow income. So they are mainly winnings from, okay, winnings is a crucial word here. Winnings from lotteries, crossword puzzles, horse races, gambling, including other forms of betting, card games, and any other games or game shows. So what I suggest you is to take down all these items. Okay, all these items individually. You will understand that by the end when we finish cash flow income, why I am asking you to take these down. Alright, so these are the items which are taxable as cash flow income as per IFOs. So pretty clear with all the items that come here. And one more thing that I would like to add on is, see, these game shows and other games can include various game shows, any entertainment programs on television or electronic mode, wherein which people compete to win prizes. Alright, all the things that you see in TV shows and all, reality shows and all. Now those kind of things are taxed here. And also lotteries include winning from prizes awarded to any person by the means of drawing lots or by chance or in any manner whatsoever under any scheme of agreement. Alright, so it's not just the lottery ticket purchase and the winning of those lotteries, but any kind of winning by way of drawing lots or by chance. Fine. So that's it about a basic explanation about the definition of what cash flow income is and what kind of things come under cash flow income. Now going a bit deeper, see, one unique feature of cash flow income is there is absolutely no deductions available. So no deductions can be claimed for cash flow incomes. Such incomes shall be fully taxable and no deductions shall be allowed. Also, no deductions from ATC to ATU are allowed. Besides ATC to ATU, there are certain deductions which can be availed for items under IFOS. Even that cannot be availed for cash flow incomes. Clear? Now also one more thing. All these items of cash flow income will be taxed at a flat rate of 30%, and that is as per section 115BB. Now what it means is, you do not have the normal taxation procedure for the items of cash flow income. Every item under cash flow income should be taxed under a flat rate of 30%. There is no slab rate or finding a person's total income, taking the slab rate and taxing him accordingly. No, that does not work here. It works in a different manner. Whatever the amount of income you get under cash flow income, you tax it at flat 30% regardless of the slab in which he falls in. Now that we learn in a better manner once we learn computation of income. So just keep that in mind. Okay. Now one another unique feature about taxation of cash flow income is there is this applicability of TDS. So in every item of cash flow income, except for cases like one, the case where the winning of lotteries is less than rupees 10,000, and two, the case where winning is from any kind of races other than horse race like camel race and all. So in those two cases, except in those two cases, everywhere there's a TDS provision for cash flow incomes, and that TDS provision implies that 30% of the total amount should be deducted at source. So in order for us to find the total income of an assessee, what we should do is we should gross up the item. Okay, so we should gross up the item in order to find the total income. So what we essentially earn out of a winning as per cash flow income is an amount after deducting tax. So we need to add back that tax and find out what our gross income is in order for us to find the total income. Now this is something that we do purely out of the purpose of our examinations, to show what the total income of the assessee is, and from that we again deduct this tax and show what is the tax paid. Fine. So that's what this table says. When lottery income received is given in question, students have to gross it up and find lottery income earned. Pretty clear. So received is something that is earned minus TDS. So there's a TDS component of 30% in earned income, as I just said, but then it's except for cases like winning amount less than 10,000. I explained that previously, and also races other than horse race, example camel race and all. Alright. So we need to find earned income from received income. So what is the formula for that? income received divided by 100 minus 70. That is income received by 30%. Now that will give you the 100% of the income. So just take income received, divide it with the TDS component percentage, and with that you will get the gross income. Pretty clear? So that's all about the TDS provisions. Now let me tell you few cases now which might a student might consider to be falling under this head, but actually does not. That's why I asked you to take down individually all these things. So let's see what they are. Exceptions. First one, winning from lottery held as stock in trade will be considered as incidental to business and taxed under PGBP. Say in the case of a lottery dealer or an agent who has a set of unsold tickets, and apparently one of those unsold tickets win lottery and he earns money, but then the money he earns shall not be taxed under IFOS, it will be taxed under PGBP because it is an event which is considered as incidental to business, that is part and parcel of that business. Alright, in such a case, any winning of an agent or a trader from any of his unsold tickets will be considered as income from PGBP. Fine. Okay, let's see what is the next item. Winning from motor car rally. It's considered as a return of skill and effort. See, motor car rally winning is considered as a result of constant effort, skill and driving prowess. And as a result, since this is not an item of chance, it is not considered as casual income. As this is purely equatable to the effort, skill and driving prowess a person has, this will not be treated as a casual income because this can happen again and again. This person who is so and so skilled and who has such well built cars can win again and again because this is not something that happened to him by chance. This happened because of his effort. This happened because of his skill. This happened because of his prowess in driving. Next one, income of jockey. Now jockey is someone who rides a horse in horse race. Alright. So when an income is received by jockey, it is not winning from horse races. It is actually the salary which is paid to him or an income he earns because of his skill in riding the horse. So it's just like winning from motor car rally, income from jockey will not be treated under IFOs. Clear? So that's it about the items which will not come under IFOs, and this is the reason why I asked you to take down and list out all the items when I previously explained. So I'll just show you those items once again. Winnings from lotteries, crossword puzzle, horse race, and this is not for jockeys, gambling and any forms of betting, card games and any other games or game shows which includes TV shows, reality shows, etc. And also remember, horse race will not include car rallies, and lotteries will only be applicable if the ticket is owned by a consumer and not an agent or a trader. Clear? Now with that we have finished casual income. Now let's go to the next item, which is family pension. See, from the name itself it is pretty easy to understand what this item of income is, right? See, it means a regular monthly amount payable by an employer to a person belonging to the family of a deceased person. Alright, so it is an item of pension, but then it is not paid to the employee. Rather than the employee, it is paid to a relative of his because the said employee has deceased. Fine. So let's see what our material tells us. It is a pension received by a widow or legal heir of a deceased employee. Just like I said, it is an item of pension but not received by an employee, but received by a widow or legal heir of his. And if it had been received by an employee, it would have been taxed under normal pension under salary. Alright, it would have been an item of salary. But then since it's received by a widow or legal heir, it is an item which is taxed under income from other sources. Now the thing with family pension is, see, I did mention when I taught cash flow income that there are certain deductions available for incomes under IFOs. Now just like that, family pension has a specific kind of deduction, and that deduction goes by the name standard deduction, and it is the minimum of rupees 15,000 or 1/3 of the pension received. Alright, so whatever the amount of pension is received by a widow or a legal heir, he or she can take a deduction of 1/3 of the pension or rupees 15,000. Now that's it about the standard deduction that an SSE can take on behalf of family pension. Now there is not much we have to learn under family pension like we learned under the previous items, but then there are certain notes that you need to take care of as in the following. First one, lump sum payment made gratuitously or by way of compensation to the widow or legal heir is non-taxable income, with the only condition that the employee passes away while he is in service. Alright, so pretty clear, nothing much happening there. An employee who is in service passes away and the employer makes a payment which is not called for, it is not legally required to to the heir of the deceased employee. Alright, now this payment is made by way of one-time payment. It's a lump sum payment which is made, and this will not be treated as family pension, and this also is a completely non-taxable income. Fine, pretty clear. Now the next item, ex gratia payment made to widow or legal heir of an employee who dies while in service is non-taxable if payment is made by central government, state government or local authority or government or public sector undertakings. Very similar in nature, it's just that it's an ex gratia payment made to the legal heir or widow by an employer who's in the government sector, central government, state government, local authority, PSU, whatever it is, a government sector employer. Alright, so that's it about family pension. Let's move to the next item, and that is share premium in excess of fair market value of shares. So nothing much happening here, just like the name suggests, it's a case where the company receives a premium in excess of the fair market value of the shares. Alright, now let's see for what all kinds of companies this is applicable. So first of all, SSE has to be a closely held company. Fine, so this is a completely closely held company. Alright, now this is the most important point in this item. So the SSE receives from a resident consideration for issue of shares in excess of fair market value of such shares, then such aggregate of excess received will be treated as IFOS income. But one key feature here is that the issue was made at premium. The issue was a premium issue. Fine. Understood? I'll explain once again. A closely held company makes a share issue at premium. Alright, let it be preference or equity, doesn't matter. It makes an issue at premium. Fine. Now, during that premium issue, the company receives a consideration which is in over and excess of the fair market value of the shares. Okay, so we are comparing the consideration received with fair market value of such shares, and if so, such excess received over the FMV will be treated as an IFOS income. So company should be any company which is other than a public company in which public are substantially interested. Alright, pretty basic, nothing much happening there. So again, a quick summary, it's a closely held company which issues shares at premium. It is not an issue at par or issue at discount, but it is an issue at premium. Alright, it's a premium issue, and the issue is made to a resident. Another key point, and the consideration received is in excess of fair market value. So these four boxes gives you a complete snapshot of the summary of this item of income. Fine. And as I previously said, this is not applicable for shares issued at par or discount. Also, this section will not be applicable if the said company, the closely held company, is converted into a company in which public are substantially interested in the very same year when such issue is made. So that's it about this section, but then there are two other topics that you need to know, just have a basic understanding of. That is the calculation of FMV and a set of companies for which this section is not applicable. So first let's check the calculation of FMV. FMV is the higher of value determined as per prescribed method or value substantiated by the company to the satisfaction of assessing officer. That's all that you have to know over here. You do not have to go in deep into the calculation of FMV. Just know it's either the value as per prescribed method or value as per the satisfaction of assessing officer. Also, This section is not applicable when the consideration is received by a venture capital undertaking from a venture capital company or a venture capital fund, or when it's received by a company from a class or class of persons notified by the central government, or when it's received by a startup which has the approval of the ministerial board of certification. Alright, with that we are winding up this item of income. The next two items of incomes that we are going to be learning under this topic is an income in the nature of interest. The first one being interest on securities. See, as per the Income Tax Act definition, interest on securities mean interest on any security of the central government or state government, or interest on any debentures or other securities issued by a local authority, company or a corporation established by a central, state or provincial act. So essentially saying applicable for any securities issued by central government, state government, local authority, company or company established by central, state or provincial act. So an item of interest which accrues from a security issued by any of the mentioned class of parties. Alright. So this item of income, that is interest on securities, is primarily regarding any kind of interest that is accrued to an assessee from these class of parties, that is the central government or state government, local authority, company established by a central, state or provincial act. Any kind of securities. Okay, any kind of interest arising from any kind of securities issued by these parties. Okay. So the tax treatment of an interest on securities can be of two ways, and they are going to be as follows. First of all, it can be treated as stock, and when such securities are treated as stock, the interest income accruing on such securities will be treated as PGBP income. But if the securities are not held as stock and are held otherwise, any income arising from them will be charged to income tax as per income from other sources. So keep in mind, if any of the securities are held as stock, then any income arising from such stock will be PGBP income. Otherwise, then such income arising from such securities will be treated as IFO's income. Clear? So that's it about the tax treatment of the said income. Now we'll be learning about certain things about their chargeability, the due date, any deductions available or anything of that sort. So let's move on to that. So first, chargeability. This income is chargeable based on the method of accounting followed, whether the assessee follows cash basis or accrual basis, and based on the accounting followed by the assessee, it will be charged. But when nothing is mentioned, then due basis is taken. Alright, simple. So it's generally based on the accounting method followed by the assessee, but if nothing is mentioned, it will be charged on due basis. Fine. Next comes the due date of interest. Such interest shall be taxable when it falls due. Alright. It accrues on the due date of interest which is prescribed by the authority, by the issuing authority, that is. Fine. See, the entire interest shall be charged in the hands of the assessee who holds the security on such date. This is irrespective of the date in which he acquires the security. For example, take Mr. X. Mr. X acquires debentures of A Limited on 7/9/2018. Fine. He acquires the securities on 7/9/2018. The debentures issued by X company has their interest due on 31st March of every year. Now, if Mr. X holds the said securities on 31st March of the current financial year, of the coming financial year, then the whole interest for the whole year will be charged on the hands of Mr. X. Got it? Even if Mr. X got such securities just a day before the date of interest becoming due, the whole interest will be charged on his hands provided he holds the securities on the date when the interest becomes due. So whoever the assessee holds the security on the date when the interest is due as per the issuing authority will have the whole interest amount chargeable to him. there will be absolutely no splitting up of the interest amount based on the period of time the assessee holds the security in the said previous year. Got it? And in case the assessee who holds the security dies before the due date, in such a case what happens is the whole income will be taxable in the hands of the person who is recipient of the income, and that is most probably going to be his legal heir. Fine, clear? So that's it about due date of interest. Now another point that we have to know here is the grossing up factor. See, we learned in casual income that we need to gross up if we are given the net income earned. Same thing is applicable here, and the format is the exact same one. Interest received by 100 minus the TDS rate. TDS rate for interest is 10%. There we learned income received divided by 100 minus the TDS rate, which was 30, which will give us the income earned. So doing this interest received by 100 minus 10% will give us interest earned. Alright. So the same thing is applicable here as well. So it depends. So we have to be really careful when we are reading the question. So if the amount is given after the collection of TDS, we need to gross it up while calculating the total income. Fine. And with that, I think we have come to the end. No. One other topic, one other thing that you need to be aware of here is that this item of income, interest on securities, have certain specific deductions that can be deducted. So various associated expenses which is completely associated with the process of earning such interest income can be deducted, and some common items of expenses are collection expenses, that is the expenses expended by the SC for the purpose of collecting the said interest income, any interest on loan, that is a loan taken for the purchase of the said securities, and any other expenses related completely, wholly and exclusively for the purpose of earning such income can be deducted. Fine. So that's it about interest on securities. Now let's go to the second item of interest, that is interest on compensation or enhanced compensation. So I'm pretty sure you guys have learned what enhanced compensation is from your study of the previous heads of income. So here we'll be dealing with not enhanced compensation. In IFOs we'll be dealing with the interest component of compensation or enhanced compensation. Fine. So first of all, one crucial thing that you need to know is the chargeability of this interest is not on the basis followed by the SSC. This interest is always chargeable in the date of receipt. So irrespective of the method of accounting followed, this interest is taxable on the year of receipt. Previously, interest on securities we learned it is taxable based on the method followed by the SSC, and if no method is mentioned, we take it as on due basis. Fine. But for interest on compensation or enhanced compensation, it will be always taxable on the year of receipt. Fine. Now, like the previously learned interest income, this interest income also has the availability of a certain kind of deduction. But then here it's not associated expenses or anything. Here what we have is a flat deduction, a standard deduction of 50% of such income. And this is as per section 57. So whatever the income is, it will be charged to tax only on the year of receipt. And on the year of receipt, we can take a standard deduction of 50%. Fine. Now that's it about interest on compensation or enhanced compensation. The next item that we are going to learn is composite rent. I'm pretty sure we came across this topic when we learned house property. See, composite rent is nothing but a rent which we receive wherein we let out a building along with furniture, plant, machinery and various other facilities, and we collect a rent for both the building and the additional things that we provide. So in a case where the rent for the building and rent for the additional things like machinery, plant and all can be separated, what we do as per the Income Tax Act is we charge the income from letting out of the building as house property income, and we charge the income from letting out of the plant and machinery or whatever it is that is we give in additional as IFO's income. Alright. But then when such when such rent income cannot be separated into two parts, what the Income Tax Act asks us to do is we have to charge it as composite rent as an IFO's income, the total composite rent as an IFO's income. If not, it is not charged under PGBP. That is, if this is not a regular business of the SSE. If this is part of the business of SSE, then it will be charged under PGBP. If not, it will be charged as IFOS. So keep in mind, an item of composite rent wherein the income cannot be split up and separated as two parts, one for the rent of building and the other for the rent of the additional facilities that we provide. What we have to do is take the whole rent, charge it as IFO's income. If it can be separated, take the part for building rent as house property income and take the part of the other facilities rent as IFO's income. Fine. That's it about composite rent. Now the next topic that we have to learn here is another kind of rental income, and that is when we let out plant, machinery or furniture. So it's pretty clear, right? Just charge it as IFO's income if not charged under PGBP, just like we learned here. Alright, so if it's a business of an SSE, we charge it as PGBP. If not, we charge it as IFOs. Alright, now for these two items as well, we can take specific deductions. Specific deductions as suggested by the Income Tax Act, and they are nothing but certain revenue nature expenses that is completely related with such plant, machinery or furniture that we are letting out on hire. Okay, depreciation and all, various things. Let's see what they are. Deductions allowed for the above incomes are any current repairs, any insurance premium paid, depreciation or unabsorbed depreciation, or any other revenue expenses wholly or exclusively incurred for earning such income. So very similar to what we learned in PGBP, current expenses, revenue nature expenses that we can deduct on behalf of plant and machinery or furniture or building that we are renting out. Fine. Sorry, not renting out, I mean letting out. Okay, so that's it about the deductions, and with that we have come to the end of the two kinds of rents that are applicable under IFOS. And also I presume we have covered almost all the topics, not all the topics, or all the important topics of items of income that generally come under IFOS for our examination. There are few other topics that I've left out which I'll be dealing with in the coming video. Things like bonus stripping, dividend stripping, deep discount bonds and all. So that we'll deal in the next video. But then so far with all the topics that I've covered till now, I suggest you to cover everything as per what is mentioned in your study material. Practice out all the problems, and if you have any doubt, just contact me. I am more than happy to help you out. So with this, I am winding up this video. We will learn about the miscellaneous topics in the coming one. So see you there.